Good morning, everyone. So I want to thank you for joining us today. We're going to be talking about the fundamentals of wealth planning. So my name is Michael Romig. I'm the owner of PG Fit. And I want to thank all of our members here at PG Fit for joining us and those that I've also invited. One of the things that we strive to do here at PG Fit is we want to set you up for success, not only with your health and fitness, but also in every other aspect of your life. So we're very privileged to have one of our clients. He's also a friend of mine and he's my financial planner, but we want to welcome Tim Hudson. And Tim, I'll go ahead and just turn it over to you and we'll go from there.
Okay, can you hear me okay, Michael?
Yes, I can. Thank you.
Okay, super. Thank you for inviting me. It's always a privilege to speak to people about financial education because I firmly believe there's certainly not enough of it in schools and workplace and homes. So I'm excited to be here to speak with you briefly about wealth planning. I'm gonna go over it about 20 minutes, so I'm certainly not going to cover everything, but I'll certainly open it up for Q&A at the end. Um, Michael has been my health planner for quite some time, and I'm privileged to be his wealth planner. So we both believe that health and wealth go in together very much so to help people live their lives with purpose because it doesn't do much good to have the wealth and not the health or have the health and not the wealth. So I firmly believe finding your passion in life is a first step. And one thing we do for all of our clients who have high school kids about to graduate is send them a link to Strength Quest. It's a Clifton Strengths assessment to help students and adults find out what their strengths are. Not right or wrong, but find out what your gifts are, your interests. And if you haven't taken it yourself, I would highly encourage you to do so. It is extremely accurate. And how many students grow up and go through college and change careers in the middle or after college? So knowing this in advance is very critical. You can go to www.strengthscrest.com, STRENGTHS, Quest, QUEST.com. So I encourage you to do that. And that's important because if you know what your passion and purpose is, you're more likely to adhere to the things you should be doing, whether it be health or wealth. So I would encourage you to do that. Certainly do that for your high school kids. Um, and the first step is having an overall plan. And everyone can see my screen correctly. Let me see if I can get this to adjust here.
Yes,
Okay.
we can.
Um, Planning, we believe, is so important. Once you know what your passion is, what your gifts are, what your purpose in life is, we begin with planning. And as you can see on this graph, we firmly believe planning is the foundation because that is something you can totally control. You cannot control the things to the right, taxes, markets, tax policies, but you can certainly plan around those things. And like in the middle, health, we can certainly control our health to some degree, right? Eating right, working out with PG Fit, following their nutrition plans, we can likely improve our health, our longevity. So those things are important. Planning is the foundation. And what goes into a plan? Well, there are 6 key elements of a plan. We'll start with cash management. We'll go to risk management, investment planning, tax planning, retirement planning, and estate business planning. All these things are linked in one way or the other. So it's very important to look at the big picture. We start with the very basics, budget, right? Nobody likes to call it a budget. Some people like to use cash flow planning or spending planning, whatever it takes to get you to do it. It is so important to know what you're spending, where your money is going. It's a limited quantity of money that we have coming into our household. And the more that we can save and invest wisely, plant those seeds of wealth for us for later, the more wealth we can potentially create. We want to identify what our needs are and our wants. We can certainly reduce our cost on needs, right? If we live in a $300,000 house, we can live just as happily in a $100,000 house. Wants as well. Pay yourself first. I will always encourage people to follow the 3 S's. Save, which means save for yourself first. Plant those seeds of wealth. Secure your emergency fund first, and then protection. You want to minimize risk wherever possible. We'll talk more about that in a minute with insurance. And then spend. You spend last. So save, secure, spend. Those 3 S's. Manage your debt. Now, if you're paying 18% in credit card debt, that's a guaranteed 18% return to you. If you pay off that debt, you're saving 18%. thereby earning 18%. So, and there's good debt and bad debt. Keep in mind that if you automobiles can be okay. You don't want to pay any high interest credit cards. You want to pay off quickly as possible. Paying 18% is unrealistic. Um, Investing at a home in today's low interest rates can be a good investment. And a lot of clients often ask me, well, should I pay off my house? Well, it depends. If it gives you peace of mind, you sleep better at night, go ahead and do that. But keep in mind, it might not make good financial sense to do that. And when I say that, I mean, if you're a moderate investor, and let's assume that you can potentially earn 8% per year over a 10-year period, and you paying 2% on your mortgage or 3% on your mortgage, that's a 5% discrepancy from what you're earning and what you're paying. That's just like you loaning me the money. I invest it and I get 8% and I pay you 3%. Anybody would do that, right? So that's what you're doing with a mortgage. But on the flip side of that, if you're paying 4% on your mortgage and you're sitting in CDs, which all your money should not be in CDs because you could potentially be going broke safely. We'll talk about that in a minute due to inflation. But if you had all your money in CDs paying 1%, earning 1% and paying 4%, I'd pay off my house because that'd be a guaranteed 4% return to you. That's a common question I get. And nothing wrong with getting out of debt. That's a good thing to do, but it might not always make good financial sense to do so. But we want to be certain that we always incorporate emergency fund in our cash flow planning. We should always have 3 to 6 months of monthly expenses set aside for times like we've just experienced in 2020 when potentially layoffs happen. Once you have your foundation, your cash management laid, then we need to address risk management. Risk management is doing the things necessary to protect your loved ones, like in life insurance, making sure you have adequate life insurance. A common question I get, excuse me, often is, I want to start planning for little Johnny's college planning. I want to start saving money for little Johnny's college planning. Well, the first step in college planning should be making sure that you're going to be around to set that money aside in that investment. So life insurance should be the first step in college planning, investment second. You want to make sure you protect your health with health insurance that can be purchased through work or individually, privately. Long-term disability, your income, the income you're going to be making over the remaining life until you retire is a lot of wealth. So you want to make sure you protect that by having adequate long-term disability. You can usually get that through work. It's if not, you can buy it individually as well. But that's protecting the goose that lays the eggs. You always want to protect your income potential. And those that are approaching retirement might want to consider long-term care insurance. Long-term care, unlike disability, does not pay you an income, but what it does, it pays for the type of care you will need if you're unable to care for yourself, such as assisted living facilities, home health care. You can stay home as long as possible, assisted living facilities, and ultimately a nursing home. A good policy would pay for all 3 types of that care. That's critical because if you do not have long-term care, and there's a high probability we will need that, you will have to spend down your assets to poverty level to qualify for Medicaid, not Medicare. Medicare does not cover long-term care. Medicaid, where you have to spend down your assets down, and that can leave a spouse destitute. So be aware of that long-term care risk. You want to make sure you protect your assets against lawsuits. If you have a teenage driver, you may want to consider getting an umbrella liability policy that will provide additional coverage above and beyond your homeowners and automobile coverage. So risk management is important. You're protecting dollars with pennies. You're paying the premiums to get that coverage in dollars. So make sure you protect it with risk management. Next, we move on to investment planning. That's where it gets exciting. You have your budget, you're setting aside an emergency fund, you've got all your risk taken care of. Now you're going to be planting some seeds of wealth. And we want to plant the seeds often. We may start small, but try to increase that over time. I'll encourage people to take the 1% challenge. And by that, I mean, start contributing to your 401k where it's painful. Make the cuts and then commit to increasing it 1% every quarter, every 6 months, every year, whatever. But take baby steps and continue. Don't get comfortable and stop saving. Keep increasing till you get to the maximum. And keep in mind, 401ks is not the only way to save for retirement, including IRAs. There's many other investments we'll talk about shortly. Um, when we invest, we want to know what our risk tolerance is. If you're an ultra conservative investor, I submit to you that you need some stocks. Even if you're a very aggressive investor, you need some bonds and cash, albeit different percentages. But understand what your risk tolerance is and understand the risk of being too conservative, understand the risk of being too aggressive. And what I mean by that, if you've got all your money in CDs making maybe 1%, inflation's at 2%, you're losing money and you're not growing your money for your future. So be cognizant of risk. And our biggest enemy when it comes to investing is our emotions. We see the market go down, it makes the headlines. Good news doesn't make the headlines, bad news makes the headlines. And it creates a lot of fear in us, and we don't want to lose money. It's just like if we touch something hot, we pull, jerk our hand back. The market goes down, we're taking our money out. That's the wrong thing to do. That's when should be adding money to it because it's on sale, the stock's on sale. So be aware of our costly emotions. Another thing is we want to invest tax efficiently, and we don't have time to go into all the details about tax efficient planning, but be aware you want to take advantage of your 401k at work, and you may have pre-tax contributions and after-tax Roth contribution options. Be aware that you're getting a tax deduction by putting into the pre-tax based on your marginal tax bracket. It's tax deductible or going in pre-tax. It means the same thing. But if you're in a low tax bracket, if you're young, not making a lot of money, you may want to consider the Roth, the after-tax bucket, because you pay taxes on the seed money going in there. But when you take it out after 59 and after the account's been open for 5 years, those distributions are completely tax-free. So I would much rather get the whole harvest out tax-free than have a pre-tax taxable distribution. So be aware of the difference and understand your tax marginal brackets to help you make the wise decision regarding that. Talk with your advisor. Um, when we invest, we want a different allocation depending on what our risk tolerance is. If you're conservative, you may have more bonds, cash. If you're aggressive, you may have more stocks. But be aware of the risk of being too conservative, too aggressive, and understand the market risk with investments. We want to allocate with different ingredients, just like when you bake a pie, you have different ingredients. Some taste good, some don't, but they come together, make a beautiful pie. Well, we want to have that allocation, but we also want to diversify amongst each asset class. So if you use baking soda in your recipe, you're going to have different names of baking soda in that asset class. Same thing with you're going to have large cap stocks. You want different names of large cap stocks in your portfolio for diversification and asset allocation. People use that word interchangeably, and it's really two different things. We want to pay attention to account titles. And by that, let me show you this is what I'm talking about. On the left, you will see that when we put into our 401k or an IRA, it's tax deductible or pre-tax. And it's also tax deferred, meaning you don't pay tax on it until you take distributions. But if you are afraid of rising taxes in the future, if you have $1 million IRA, that's not all yours. You're going to have to pay taxes at unknown tax rates in the future. So be cognizant of that. You might want to consider a Roth contribution where you pay the taxes today and get the whole harvest out tax-free. And keep in mind, if your income limits are under certain amounts, you can do the 401k and also do a Roth IRA in addition to that over here on the right. But the biggest mistake I see people making is that they accumulate most of their wealth in their pre-tax IRAs. They go into retirement years and they have this $1,000,000 IRA. It's all going to be taxable at unknown tax rates when they take it out in the future. Remove some of that uncertainty by maybe contributing some of that money to Roth IRAs. Pay taxes today. The other account, the second most valuable account in addition to Roth accounts, is the taxable account. And what I mean by taxable, it's an individual joint account, a trust account. It's not tax deferred. It's not an IRA account. It's money you put money in today and you get a 1099 every year for the interest earned, for the dividends received, and for the capital gains. Today, the maximum dividend and long-term capital gain rate is only 20%. It could be 0 or 15% for some people, depending on what your marginal tax bracket is. So be aware 401ks, Roth IRAs are not the only way to save for retirement. Make sure you put some after-tax money aside in this taxable account. That's a valuable account, because when you go into retirement, there's a lot of tax strategies you can incorporate, including Roth conversions. Because if you have a $1 million, if you have a $100,000 salary, you go into retirement and you take out of the pre-tax accounts 100,000, you can't change your marginal tax bracket, none whatsoever. You still have that marginal tax bracket. But if you save up enough money in a taxable account, that most of that money's already been taxed, and use it to live on for a few years, then you can do Roth conversions from those pre-tax accounts to Roth IRAs at lower tax brackets. So be aware, there's a lot of different tax strategies to talk about there, but let me see. Then we go into retirement planning. I'll get back here. Retirement planning. Retirement planning is a different stage from wealth accumulation. Your tax strategies can be different. The investment strategies can be different when you're accumulating wealth. But when you start distributing that wealth, going into retirement, you need a whole different plan. You need a whole new retirement income plan along with different tax strategies. You want to make sure that you've got a roadmap from get to point A to point B tax efficiently, and make sure that money will last for your lifetime. And there's lots of ways to do that with Monte Carlo testing the probability of that account succeeding. Have contingency plans in your retirement account as well too. The more guaranteed income you have in your retirement plan, such as Social Security, your pensions, and sometimes some annuity income, the more secure your retirement plan will be. The less dependent you would be on the financial markets. But you want to incorporate tax efficiency in that retirement income plan. And also, at your demise, you may want those assets to go to your heirs or to a charity tax efficiently. There's lots of considerations in that aspect as well. The other consideration we need to talk about is estate planning. Most people think of estate planning as wealthy people leaving a legacy. And that's true, that can be part of it. But your basic will, your power of attorney, your healthcare directives, all that is important to have current. And that's a basic estate plan. Some people may want to consider trust, especially if you have a special needs child. You may want to consider a special needs trust, which is a certain type of trust set up for special needs children. There's all different kinds of trust depending on what you're trying to accomplish. But talk with an attorney, talk with a financial planner, and discuss your estate planning strategies. There's lots of things you can do to leave assets to your kids, to your favorite charity tax efficiently. And planning starts today, not when you get to retirement, and not when you pass away. You start the planning today. In closing, I just want to leave a few considerations. These are the biggest concerns for people today. Rising taxes. This is what keeps me up. This is what I'm fearful for. Not today, not next year, but down the line. Rising taxes. So there's a lot of strategies you can do today to plan for that. Inflation has been pretty mild lately. It's sitting at 2%. It will eventually come back along with rising interest rates. We want to manage our portfolio risk, and we want to plan, have a roadmap to make sure we do not run out of money, right? And we're living longer lives today than ever before. There's a 25% chance of a couple who is 65 today. There's a 25% chance of one of them living to 96. So with that, I'd like to open it up for any questions you have. This is some very basic concepts, but we can dive as deep as you want to. So if anybody has any questions, Michael, how are we going to handle the questions, or do I?
Yeah, so if you have any questions, go ahead and just take yourself off of mute, and then you can ask Tim directly.
Hey, Tim, it's Tammy. How are you?
Hi, Tammy. Great.
Good. I've been looking into creating an account for each of my children.
Okay.
I have 4 kids, 24 to 16 are their ages. And I was looking at just starting an IRA for them, or a 401k.
Mm-hmm.
But then I started learning more about the MPI accounts, the maximum premium indexing. And I'm just curious, if you had to lean one way or the other, would you prefer the 401k or the MPIs?
I'm not sure what the MPI is, Tammy. I'm not quite sure what that is. But what I tell my clients is that if they want to start setting aside money for children, if they have earned income, what I mean by earned income, if they're working and have a part-time job while going to school, or if the parents pay them an allowance, that's earned income. Whether they file a tax return or not, because sometimes they're not required to because they don't make enough, but it would be wise to do so um, to verify that income. When our boys were young, my wife we paid them income, and my wife filed a tax return just to document that they had earned income. So if anybody has earned income, regardless of their ages, they can open what's called a Roth IRA. And the Roth IRA is no tax benefit today, but that is going to be a huge tax-free distribution after they reach 59 and a half. Now, then some people may say, well, the kids may need the money. Well, they can always go back and retrieve their contributions they made to that Roth IRA at any time with no taxes or penalties. They just can't take their earnings out until they reach 59 and a half without taxes or penalties. So if they have earned income, that would be a great thing to do. If they're young and you want to set aside funds for college, the 529 college plan is a great thing to do. A lot of our grandparent clients are making contributions every year to them for their future. And we give them a card and they send in a check to the fund company. And then they make another card out to the child or grandchild and give it to them and say, Mom and Pop made a donation of $100 to your 529 plan. So that's a great way to invest in an appreciable gift instead of a depreciating a gift.
Do you know if the 529s apply only to undergrad, or is it also graduate school?
It's everything. And even some vocational schools that are approved on some criteria. I'm not quite sure the details, but yeah. Now, if they're not going to school, if you don't anticipate, or they got the college covered and they don't have earned income, the next thing would be an UTMR account, Unified Transfer to Minors Act, where the parent or grandparent would be listed on the account, and it's taxable to the owner, but you list the child as the beneficiary of the account. So it's no tax benefit, it's taxed as normal. But then when the child hits the 18, then it becomes their funds automatically. And that money can be invested in a bank CD, a mutual fund, or any type of an account. Does that give you some options there?
It does. My kids are older. Like I've got a 24-year-old, a 21-year-old, and almost 22, 19. So some of these don't apply to them, but I was just curious about the MPI, if you've heard anything about that. It's basically a combination of life insurance, stocks, and compound interesting.
Yeah, I have not heard of those. And I have heard of people using life insurance in the past for kids, college, and that's a mistake. Life insurance needs to be on the parent if it's used for college, because but good. Thank you. Good question.
Hey, Tim, what was that account you said? It wasn't MPI, it was Universal.
UTM, Unified Transfer to Minors Act, UTMA.
UTMA. Okay.
Yeah, a child under the age of majority cannot just go open an investment account. Same thing with a Roth account. The Roth account has to be a custodial Roth account if the child opens it. The parent would be listed as the adult, and then the child would be the minor.
Okay, great. Thank you.
Mm-hmm.
Does anybody else have any questions?
Hey, Tim, can you hear me?
Yes, I sure can.
This is Troy. Quick question. You were saying, you kind of talked about kind of getting rid of debt or whatnot. If I have an account, let's say the Robinhood or something like that with some investments, should I take some of those funds to help pay down some of the debt now, or keep some of the investments that I have or whatnot? What's more important?
Yeah, good question there, Troy. That's a common question I get too. It depends on a lot of factors. First of all, you want to make sure you don't spend your emergency fund. You've got that emergency fund set aside. I would not even pay down the debt there. I would keep my emergency fund for emergencies. If you have extra investments, then the question becomes, what am I earning on those investments, and what is my debt costing me? So if you feel that you can get a better return on the investments than the debt, then I would probably keep the investments and pay off the debt. But if it's close, I would probably pay off the debt, because those investments can go up and down in value. But if your investments are very low performing compared to the debt, I would certainly pay off the debt. Yeah.
Okay, thank you for that.
You bet.
Yep, absolutely.
And you may want to consider tax consequences too. If we're speaking of a mortgage and you itemize it, which is harder to itemize on your tax return today because of the new tax act, but that could be changing with the new government. We could have seen some new taxes and deductions changing this year or probably next year with the home mortgages and the real estate taxes, property taxes.
Great. Does anybody else have any questions?
I just have one clarification.
Sure.
The Social Security payouts, are they still set to change down to 70% in 14 years or 13 years?
Well, they're not scheduled to change, Tammy, but they are scheduled. Well, the projections based on the Social Security Administration Board of Trustees show that they're going to only have enough money to pay out 70% of the amount that's going to be required to pay the retirees. Now, that's projected, and that's the reason I don't think they're going to reduce the paychecks. That would kill the economy, and countless people would be suffering. But what I do believe is that that's my concern for rising taxes, because they're going to pay these people. It's just like they're going to tax the others. Yeah.
Okay.
Good question. And that's why tax planning is so important, not just to reduce taxes today, but look over the horizon. Social Security, those things are coming. Medicaid's in worse shape than Social Security. They can't do away. They're talking about expanding it. So, you know, it's rising taxes on the horizon, over the horizon, in my opinion. Could be here next year.
What about you, Mary Jessie? Do you have any questions?
No questions.
Okay. Patricia?
No questions. I'm familiar with Roth and the estate planning and 529. I did that for my daughter.
Super.
I'm in stocks right now, playing around with that. I do need to get a will together. I have it handwritten and notarized, but I also want to get a will together and probably do like a trust for the younger ones, but that's planning and getting going on that. But other than that, I'm good.
Great. Tim, do you want to just talk about that just briefly? So the difference between a will and having an estate plan?
Well, yeah. People with minor kids, it may not be necessary to go and establish a trust. What you can do is stipulate in your will that a trust would be created upon your demise for the benefit of so-and-so to be administered by so-and-so as trustee and so-and-so as co-trustee. So you don't go through the cost of establishing a will, but you have it in your will, establishing a trust, but you have it listed in your will. It's called a testamentary trust. So discuss that with your attorney, testamentary trust. And then there's all different kinds of trust too. As I mentioned, you know, people may open up a living trust to put their assets in today. It doesn't avoid any estate taxes, which are pretty high today, are likely going to come down.
Okay. So
I'm sorry, go ahead, Patricia.
Yeah, just to get clarification. So in the will, you can put in there who's going to be managing that so-called
Absolutely.
testamentary trust. Okay.
And you can list somebody who you would wish to manage it, and so if something happened to that person, that would be good to do as well too. Mm-hmm.
Yeah, because I have children from another ex-husband, so my two youngest ones, I want to make sure that if anything happens to me, that you know the money that I've got set aside for them, they don't get it until they're 27 or so forth.
Yeah.
So,
yeah.
Okay.
And then it's good to make sure you review all your beneficiaries in addition to getting the will, get the testamentary trust, and naming a custodian for your kids. Double check all your beneficiary statements. Make sure you have all those current.
Okay. Thank you.
Yes, ma'am.
What about you, Susan? Do you have any questions? I know you also do some wealth planning as well, so.
Yes.
Like
No, I don't have any questions at the moment, but thank you, Tim.
You bet. You bet.
Great, thank you. Tim, could you talk on one more thing? I know we
Sure.
just briefly talked about retirement.
Mm-hmm.
Could you just talk briefly about what would happen if somebody is already retired? You know, what should their retirement planning strategy look like? If you can just give them some ideas.
Yeah, I can, in general, what I find is that a lot of retirees elect Social Security too early. They make the bad decision, especially if they're married, because once you take Social Security, it is locked in. You know, if you get it before your full retirement age, which is based between 66 and 67, depending on what year you're born, that is the locked in amount. And it may increase a little bit for inflation, but that's not going to change based on your age. Married couples, in general, again, we do a Social Security report for every our clients, but in general, I find that it's usually beneficial for the higher income earner to defer theirs to age 70, because you get an 8% increase in the benefit from your full retirement age up to age 70. So where can you get a guaranteed 8% day? That's it right there. But every case is different, but I'm just speaking in general terms. And I think the biggest risk facing retirees today is the fact that we're going through such low interest rates. You know, a lot of our parents and grandparents, they retired, got the gold watch, got the rocking chair, and they didn't have much life longevity. Today, my father passed away in October at 93, so our parents are living longer and longer lives. And you know, as I mentioned, there's a 25% chance of a couple, one of them living to 96. So we can't invest like our parents and grandparents did, just put the money in CDs or bought bonds. And you need to understand the inverse relationship between bond values and interest rates. As interest rates go down, the value of bonds go up. And let me explain that. Because if you bought a bond in 1980 paying 15%, and interest rates go down to where they are now, basically 1%, who's going to buy your bond at 1% who's going to buy your bond? I mean, you can name your price for the bond at 18% for the value, because that's appreciated. It's much more valuable than buying one today at 1%. But if you buy a bond today paying 1%, bonds go up to 2%. You're going to have to sell that 1% bond at a discount because they can buy one on the market at 2%. So what I'm saying is that I think the biggest risk to retirees is the fact that they tend to be some tend to be more conservative, and that means you own more bonds, and you're going to be facing some headwinds with the interest rates at some point when they come back. So I think that's where a plan comes in, to look at your options, see if you sustain what kind of portfolio you need to be sustainable or have a high degree of probability of being sustainable. The other thing is having your legal documents in place, having a roadmap showing your high probability of success from getting from point A to your longevity. Long-term care is another costly. I've seen vast amounts of wealth had to be spent down to qualify for Medicaid and leave a spouse destitute because they didn't have long-term care insurance. So it's expensive. It's a lot more expensive not having it. So yes, ma'am. Go ahead.
Oh, I'm sorry. Do you have, do you sell long-term care, or do you have a recommendation on?
When our clients want it, we go through a brokerage house and they search different companies, but you can go through your insurance agent and get it as well too. Just make sure they're knowledgeable on it, and make sure they check in different companies, because there's a lot of different options. For instance, you don't want a plan that pays daily benefit. You want a plan that pays monthly benefit, because if you stay home, which most of us want to stay home as long as possible, that
Right.
home aid would come out. It may be a lot more than that daily benefit, but it would be paid if it's a monthly benefit, as long as you don't exceed the monthly benefit. And they don't typically come out every day, once, 2, 3 times a week. So
Okay.
things like that. You want to make sure you got adequate inflation, because you're not buying it to use it today, but in the future. So make sure you got an adequate inflation rider on there. Yeah.
Thank you.
Good
Hey,
question.
Tim, what are
Yes, ma'am.
your thoughts about money markets?
Money markets are kind of like CDs. You don't have very little risk, no risk to the money, but you're not making anything.
Okay.
Then we do need some, if you've got your emergency fund, that may be a good place to keep your emergency fund, because you want to keep it safe. You don't want to have an emergency, need the money, and the market be down. So that's the purpose of the emergency fund. But yeah, it's not really a good long-term place
Okay.
for money.
Thank you.
Mm-hmm.
Hey, Tim, one more thing. So what, can you explain the required minimum distribution when you turn
Good
70?
question. Yeah. Before January 1st, 2020, everybody had a required minimum distribution date. When they turned 70 and a half, they would have to take out of their retirement accounts. That means 401ks, pre-tax 401ks, and Roth 401ks, traditional IRAs, but not Roth IRAs. Roth IRAs do not have a RMD age. Now Roth 401ks do. You better get that to a Roth IRA as quickly as possible because Roth IRAs do not. Now, with the new legislation that was passed last year, they changed that so that the new RMD age is now 72 if you were not 70 and a half on January 1st, 2020. So most of us on this call, I think all of us, we're gonna have a 72 is our new required minimum distribution age, where we have to take out the amount that's based on our life expectancy. And those tables are likely to change. I know on the old tables, if you were turning 70 and a half, it would be, you would divide the balance on the previous year before you turned 70 and a half by 27.1, I believe, and that would determine your required minimum distribution that you would have to take out. Now, all of our clients, they have to take this money out. They don't want it. We just take it out and then we shift it over to a taxable account. So, but it has to come out and it has to be taxed. A common question I get is, can I do a Roth conversions with that money? And the answer is no. But by doing Roth conversion is when you take amount of your IRA and convert it to a Roth IRA, but you have to pay tax on the amount you convert. So you want to pay close attention to what that does to your marginal tax bracket when you do that.
And I noticed that we have a couple of people that are in their 20s and 30s on the call. What would be your primary advice for those individuals?
Oh, I've got clients calling me and introducing me to the college graduating kids, and I so much enjoy giving them some. And it's good when I hear the results. So I mean, it's such rewarding to hear the success stories. Best advice I can give them, like I would any child, if you have earned income, start that Roth IRA first. Start that Roth IRA. Set some money aside for emergency funds, get that emergency fund, but start that Roth IRA. If you have a company sponsored retirement plan, start participating in it. If they give you a match, let's say 3%, and you're not participating, you leaving 3% of your salary on the table. At least start at the minimum, whether you get the match, and then take the 1% challenge, increase it 1% every quarter. You can adjust your budget over time to get to the maximum amount as quickly as possible. So do the Roth IRA, and on the 401k, if you're in a pretty low bracket, you may want to consider contributing to that Roth IRA, that tax-free bucket later. You're putting in money that's not, you're not saving any taxes today, but I'd much rather have an IRA of $1 million coming out tax-free than coming out at unknown tax rates in the future. So manage your cash flow. Don't stop there. Do those after-tax accounts we looked at. This taxable. Do the Roth IRA, do the 401k, and the 401k might be in a Roth 401k, but start setting some additional investments aside in an individual account or joint account. That's going to be the most valuable. Next to the Roth IRA, this is your most valuable bucket for tax planning later in retirement.
And if somebody wanted to set up an investment account, what would you recommend?
Go to the parents advisor. Advisors typically take on the kids as clients, or you could go to Vanguard online. American Funds is a great fund family. You go online and open the accounts too, or check with your parents advisor. Mm-hmm.
Great.
Yeah.
Does anybody else have any final questions or comments?
Tim, are you going to show us your contact information again? I didn't catch
Yeah, sure. I'm sorry. Yeah, that's right. I'm located inside the credit union. I'm not part of the credit union. We just office in there. We have a partnership with them, but we're right here at Skinner. Yeah.
Thanks.
We offer free consultations. So yeah, and come in and. we ask that you do bring some information when you come so we can have a meaningful meeting and give you some good advice. Yeah.
Yeah. Now, Tim, I know that you just did this. You weren't expecting to really get anything in return, and we really appreciate that. But why don't you just tell us a little bit about Silver Star Wealth Management and exactly what services you offer? And
Sure. We're passionate about planning. We won't take on a new client without a plan, because a lot of advisors will, but I just, you're not doing the client service, in my opinion, because it takes time to understand a client totally, so that before I can make recommendations that I'm a fiduciary. So if any recommendations I make to my clients, I'm willing to put them in writing them and ask the client to, because ultimately it's the client's responsibility to see that it gets done, but we're here to help them. So we don't take on a new client without a plan. That is the foundation. And once we do the plan, the client can see, oh, wow, this makes sense. And we can see the full aspect of the client's situation, so that we're in the best position to make the best recommendations for these clients. And we dive into what's important about you. It's, what's your purpose? What's your passion? What does money mean to you? These are very important questions. We want to get to know our clients very well before we even make any recommendation to them. So we specialize in comprehensive wealth management, retirement income planning, gifting. And we've got wealth accumulation clients. We've got wealth distribution clients. So, and we help a lot of our kids, of our clients. And so we kind of multi-purpose, but real focus on the planning aspect and the tax efficiency. That's what I'm passionate about, planning for taxes. You know the difference between tax evasion and tax planning? 15 years. We do tax planning, not tax evasion.
And I'll just add, when I married my husband, he came to this relationship with the Graduate School of Debt. And so when he first was employed, he was offered an option to pay for a financial planner. And even though we didn't really have any spare money, we went ahead and jumped on it because we knew we needed to get control of that debt. And it has worked out to be the best thing that we've done. And we were, 24, 25, 26 years old, not really knowing where we wanted to go in life. And by the time the 2008 crunch hit, we were set. We could ride that out. It was very comfortable. So I don't know what the future holds for everyone, but I just had to say, even if you're like, I don't need a financial planner, I don't have any money to plan for, you have debt to plan for. So that's my spiel, and it's worked out well for us.
That's true, Tammy. Most of us don't know what we don't know, right? And it's what we don't know that can either help us or hurt us. Very true. Mm-hmm.
Well, Tim, I want to thank you very much for taking time out of your busy morning to share this valuable information. And thank you to everybody that joined the webinar this morning. If you do have any questions for Tim, he's got his contact information there. But thank you very much for joining us, and have a great weekend.
Thank you.
Thank you all. Appreciate it.
Thank you.
Thank you.
Thank you, Tim.
Thank
Thank
you.
you, Jim.
Thank y'all.
Thank you.
Appreciate it. Have a
Thanks.
good day.